Hello, everybody. Welcome to the Main Street Money Podcast. I'm Andrew Gay, joined as always by Zachary Green, and we're wrapping up another busy week in financial markets and the economy. Zach, good to have you back on.
Yeah, glad to be here. Feels like every week lately there's been another major headline driving a market, so we've always got something to talk about.
That's it. This week has had record highs across the board in the stock market. Inflation data, interest rate conversations, earnings season continues to come in strong, and then a little volatility to close out the week. So we've got a lot to unpack today.
Yeah, and I think everybody is trying to figure out how everything really fits together right now. The economy feels really expensive. Rates are still really high, but markets are still hanging around all-time highs and kicking butt the last few weeks. So
yeah, they are. And that's really the goal of this show, is to take all the Wall Street noise and translate it into something practical for everyday investors. So let's start with the markets. And we have 6 segments for you today. So first up is the markets. It was another strong week overall for equities or stocks. Midweek, the S&P 500 and NASDAQ both pushed into fresh all-time highs before pulling back just a bit early today. The S&P actually briefly crossed 7,500 for the first time ever this week, while the Dow moved back above 50,000 again.
Still sounds kind of crazy to say out loud, honestly.
It does. It really does. I mean, I remember when we were wearing the Dow 20,000 hats, and to see the Dow cross 50 is crazy. Even with today's volatility, though, the numbers have still been very impressive. As of Friday, today, the S&P 500 is still up roughly 1.4% on the week and nearly 10% year to date. The NASDAQ is up about 1.5% this week and almost 15% for the year. Even the Dow is positive about 4% year to date.
Yeah, honestly, after the run-up we've seen the last few weeks, some profit taking probably isn't all that surprising. And I think it's safe to say we're seeing a little bit of that this morning.
Yes, I think it's safe to say that. I would agree. Markets don't move in a straight line forever. Friday's move looks more like investors locking in gains than some major panic event. Tech led a lot of the selling today after leading most of the rally over the last few months.
Yeah, which has kind of been the story the entire year. AI and tech spending continue to dominate, and earnings.
Yeah, and here's a stat that really puts this rally into perspective. The S&P 500 only crossed 7,000 about a month ago, and now it already touched 7,500 intraday this week. That's incredibly fast move, historically speaking.
Yeah, that's a lot of momentum in a short amount of time. I remember thinking it was going to be tough to get past 7,000, and it just
it is. And momentum cuts both ways, which is why volatility has picked up lately. We've had multiple 1% daily swings recently, as investors constantly are repricing inflation expectations, excuse me, bond yields, and Fed policy.
Yeah.
And if you didn't catch it, if you're following along with video here, there is a market update on the screen for you there that kind of corresponds with what we're talking about. So higher rates matter more for most companies where investors are paying for future growth. So let's segue into inflation. So our second segment's about inflation. So this week, the inflation data that came in was hotter than many economists wanted to see. Prices are still rising faster than the Federal Reserve would like, and consumers are definitely feeling it.
Yeah, especially at the gas pumps and grocery store.
Right. And I feel like that's really where we notice it the most. Energy prices have remained elevated. Food costs are still sticky, and everyday expenses just feel heavier than they did just a few years ago. But here's the important distinction. I want listeners to understand this. This is not exactly the same type of inflation that we experienced back in 2022 when the Fed first started hiking interest rates. Back then, it felt like literally everything was exploding higher all at once. I mean, the move upward for inflation back then was so fast. Right now, a lot of the pressure is concentrated in certain areas like energy, insurance, housing-related costs, owner's equivalent rent that we talk about on here pretty frequently, and services.
Mm-hmm. Yeah, so inflation's still very much a problem, but not the same kind of runaway environment we saw in 2022.
That's right. And markets are paying close attention to that distinction because it directly impacts what the Federal Reserve does next. And speaking of the Fed, let's segue into our third segment, which is interest rates and the Fed. So the Fed remains in a difficult spot right now. Inflation is still above their 2% target, but rates are already restrictive enough that consumers and businesses are definitely starting to feel the pressure.
Yeah. Mortgage rates are still elevated. Car loans are expensive. Credit cards are expensive. Borrowing money right now just is not cheap.
No, not at all. And earlier this year, markets were expecting multiple rate cuts between now and the end of the year, and those expectations have really shifted. Investors now think rates may stay higher for longer than originally anticipated. That's not a new narrative, but we've even seen on the CME Group FedWatch Tool a percentage chance pop up for the expectation of a potential rate hike between now and the end of the year.
Yeah, and I think that's shocked a lot of people who were really banking on those rate cuts coming through.
Yeah, I think it has. I think you're right, Zach. But the Fed keeps repeating the same message. So in their press conferences, what they've been coming out and saying has been clear and consistent. They need more confidence that inflation is truly under control and continuing to moderate before they start easing monetary policy. They don't want to cut too early and accidentally reignite inflation all over again. That would be considered a policy error, and they don't want to do that. And so one interesting stat here, the Fed's most recent vote was one of the most divided that we've seen in decades, all the way back to, I think, 93 or 94. That tells you that policymakers themselves are wrestling with the same uncertainty that us investors are.
Yeah, the Fed's really have to do their balancing act with the dual mandate right now.
It is a balancing act. That's exactly what it is. And this is where I think investors need to stay disciplined emotionally, because markets are constantly repricing expectations around rate cuts, inflation, and economic growth. That's why you're seeing these bigger day-to-day swings. All right, so that's the Fed and rates. Let's shift gears into the labor market and the consumer. So one area of the economy that continues to hold up pretty well has been the labor market. Job growth has slowed from the really overheated levels that we saw a couple of years ago, but employment overall is still very, very resilient. We just got an unemployment number which stayed steady at 4.3% for the most recent month.
Yeah, which is really important because the biggest driver in our economy is the U.S. consumer, which is made up of working people.
Yeah, and I think the number is something like 70% of our GDP or something is driven by the American consumer. So if people are employed and paychecks are still coming in, consumers generally keep spending. But I do think households are becoming a little more selective. People are noticing like higher prices. They're noticing higher financing costs, borrowing costs. They're becoming more intentional with their spending decisions.
Yeah, a lot of the families are starting to feel the squeeze right now. Even with incomes being higher, it doesn't mean those incomes necessarily outpaced inflation. And now you got the gas issue to stack on top of that.
Right, and it feels like it's just really hard for the consumer to get ahead.
Yes.
And that's a really important point.
Yeah.
Wage growth has improved, but in many cases, it still feels like costs rose faster than incomes over the last several years. So even though the economy on paper may look relatively solid, people don't always feel that strength of the economy in their pocket or in everyday life. And honestly, that disconnect is part of why consumer sentiment has stayed somewhat cautious, and it's sitting at multi-year lows right now. So for our fifth segment, we're going to talk about economic growth. Looking at the broader economy, growth has remained positive, which is important. We're not currently seeing the kind of economic collapse many people had feared that we thought we would have seen by now when rates first started rising aggressively back in 2022.
Yeah, I think that honestly says a lot to how resilient the economy is, which is kind of funny because I think back to Jerome Powell always iterating how resilient the economy was. I thought it was just a sales pitch, but he might have been onto something.
Yeah, no, I think resilience is a good word to describe the U.S. economy currently, because business investment has stayed relatively healthy, especially in areas tied to technology and infrastructure. We all know about the CapEx spending frenzy that's going on right now with the hyperscalers. AI spending continues to be a major driver of what's driving financial markets right now. And at the same time, we're still watching for signs of slowing beneath the surface. We've talked a lot about stagflation, where an environment where growth slows, but inflation continues to remain elevated. Higher borrowing costs eventually work their way through the system. It just takes some time before we maybe see some of that slowing.
Yeah. And it's kind of a weird environment right now where some parts of the economy are looking kind of good and then other parts are looking really bad. So it kind of goes back to that. How does it all fit together kind of thing?
Right. It's kind of this fire and ice narrative, or even like we've heard it come up in the K-shaped economy recovery that we've been talking about. But that's probably the best way to describe it. It's mixed. And that's why markets have had these periods of volatility recently, even while the indexes remain historically elevated. Yeah. All right. Shifting gears into our sixth and final segment, which is earnings and why the market is still at all-time highs. So we're going to answer the big question. If inflation's elevated, rates are high, and consumers are under pressure and consumer sentiments at multi-year lows, why are markets near all-time highs?
Big earnings.
On our last episode, we said profits.
Yeah.
That's it. And it's corporate earnings. Honestly, earnings season has been much better than expected. Roughly 84% of the S&P 500 companies reporting so far have beaten earnings estimates, which is one of the strongest beat rates we've seen in years. So if you don't know this, there's analysts that come out and give guidance on what they think these companies are going to report when they report their earnings. And then if the companies come out and they beat the average analyst expectations, that's considered an earnings beat. So 84% of the S&P 500 companies reporting so far have beaten their earnings estimates, which is a high number.
Yeah. And a lot of that has been done in the technology and AI related space.
Yes, it has been, which has been eye-opening. I think we had a conversation with an analyst earlier this week. And I think the most recent GDP number, though, those two pieces of the GDP number added, which was 2% annualized total, I think those two segments added 0.8% of that 2% number, which is like half of it. It's a lot. Yeah. So heavily weighted and tilted towards those two segments. One thing that we might want to watch closely here is whether this consumer can actually hold up under continued higher costs and higher rates. Savings rates have like dipped down some, but like we were talking about, the consumer has seemingly continued to spend. But eventually, if consumers slow down enough, corporate earnings will feel that too. And those expectations would be that, hey, these corporations are going to make less money now. And a lot of times, if that thinking bleeds into markets, you're going to see it sell off some.
Yeah. So I think what you're kind of getting there is earnings have been the strength story so far, but that may not last forever, and investors still need to stay balanced and realistic, even though the economy is resilient right now.
Yes. And I think realistic and balance are a great way for investors to be thinking about this market right now. So it's not an environment for panic, but it's also probably not an environment for complacency either, which is why we are here. So let's wrap the show with a quick summary for this week and a reminder that if you want to know how any of this information applies to you or your situation, or you have questions about your financial picture in general, you're welcome to reach out to us. We never charge for conversations or just a consultation. All right, so markets remain near all-time highs despite some volatility to end the week. The S&P 500 briefly crossed 7,500 for the first time this week ever. The Dow moved back above 50,000, and the NASDAQ continues leading markets higher on AI-driven momentum. Inflation continues running hotter than the Fed would like, which means interest rates may stay elevated longer than many originally expected. Treasury yields moving back above 4.5% have added pressure and volatility to markets. The labor market's still holding up relatively well, but consumers continue feeling pressure from higher everyday costs. Economic growth remains positive overall, and corporate earnings, especially in technology and AI, continue to support the market.
Yeah. And I think a big takeaway right now is there is a big difference between uncertainty and crisis. So right now, markets are dealing with a lot of uncertainty, but that does not mean we need to panic and freak out, because that's when bad decisions are made in your portfolio.
Yes, they're emotional decisions, right? So I think that's panic. We're not quite there yet, but this is not a time to be sitting around and doing nothing either. And I would also add that if you've had a portfolio that's being managed for, I don't know, like 10 years plus, and you haven't really gotten in there and reviewed your allocation and what you're doing, now might be a really good time to do that, because things have changed so much in the technology space that have allowed investors access to other tools that weren't even around 10 years ago. So it's important to stay on top of that and talk to someone about it that's licensed and can give you some guidance. So thank you guys for tuning in. We appreciate it. This is our second episode, I think, of doing just Zach and I. It's probably going to be like this for here on out. Gilbert will pop in every once in a while, but we appreciate your viewership, your following, and please tell someone about the show. Share this with your friends. Helps other people find us. We're on Facebook, LinkedIn, and YouTube. Thank you so much. Have a great weekend. We'll catch you back here next week. Oh, and one last closing piece. Oh, yeah. Wanted to mention our webinar that we're putting on. It's a free webinar that's taking place at noon on June 2nd. You can just go to the registration link, sign up. It doesn't cost anything. You can log in from your phone over lunch if you want that day and listen in and get some good economic updates, as well as some ideas about tax smart investing from our partner, Russell Investments.
Mm-hmm. And you'll see these handsome guys right here.
That's it. Yeah. Thank you guys very much. Have a good weekend. See you next week. Securities and investment advisory services offered through LPL, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.